Why manage risk? Why manage risk? Answer is very simple. Answer is very simple because risk is uncertainty and then avoiding the uncertainty. But without the presence of risk, profitability is going to be negligible or very low. So there has to be risk and it has to be managed. So why manage risk? Asset and liabilities are mismatched. Liabilities, the mobilizing of funds, deposits in the financial institutions, and through the deposits and the shareholders' funds, there is going to be assets created, assets, loans, and various other investments, and so on and so forth. So if these maturities of the liabilities and assets are matched, then there is no risk. Then there is no risk. Only risk is the pricing, where assets has to be priced higher than the liabilities. But as we learned at the beginning, I must remind you that concept as well. The liabilities of a financial institution range from, other than the shareholders' funds or equity, other deposits range from savings accounts, current accounts, fixed deposits, and various other deposit types or customer placements, customer deposits with the financial institution. If we run through the maturity profile of the liabilities, savings deposits and the current account deposits are termed as on-demand funds. When it is on demand, the financial institution has to be ready to repay on demand when requested for withdrawal by the depositor. So therefore, you might recall we discussed the maturity gap analysis, the maturity buckets. However, the savings and current account deposits are not withdrawn always. In the sense, day to day, they are not withdrawn. Only about 3 to 5% of them are withdrawn by the depositors. So balance 95% is going to remain with the financial institution, provided good reputation is maintained and good compliance culture is maintained to the law and order regulations and the reputation with the customer and the markets are very much important. If that is so, if the compliance culture and the reputation levels are maintained by the bank and the financial institutions, then there's going to be new deposits coming in as well. Apart from the existing deposits, which are generally 3 to 5% withdrawn by the depositor, balance 95% is going to remain in the institution. On top of that, there is going to be new deposits coming in as and when the day by day passes on, and provided the economy is expanded or grows, if there's a growth in the economy. So therefore, naturally, there is going to be a hard core of savings and current account deposits, which are spread on a division made by the ALCO towards other maturity buckets. A good portion of about 40 to 50% is going to be categorized to the longest maturity bucket, say 5 years and over. Then when we talk of the liability side of the fixed deposits and other various types of deposits, maximum deposits tenor that we have seen is 5 years, but majority of FDs are in the region of 1 year. So all in all, if we take the entire liabilities profile or deposit base, majority of them are in the region of 1 year maturity or little less. So therefore, total liabilities profile, maturity profile is hovering around 1 year time zone. But when it comes to asset side, the loans granted and the investments in treasury bills and bonds and the wall cash is you have cash with you anytime to repay the customers to match the liability with withdrawals. However, the investment in treasury bills, treasury bonds, and other like near cash liquid assets can be 3 months, 6 months, 1 year T-bills, and 2 years to roughly about 10 or 15 years or maximum 20 years treasury bonds. Now, because there is a ready secondary market for treasury bills and bonds, they are also technically could be categorized as next day funds or the closest maturity bucket. But the problem is going to arise when about 60 to 70% of the liabilities are lent to other customers as loans and advances. Housing loans, shortest tenor is going to be overdrafts, where the overdraft advance can be recalled any day, anytime by the bank. And others going to be trade finance loans and sometimes leasing and credit card balances. They are going to be in the region of 3 months, 6 months, or less than 1 year. However, the housing loans and the project loans in a balance sheet of a financial institution is going to have a tenor of 5 years, 10 years, 12 years, 15 years, or 20 years, or 25 years housing loans. So you see the profile of asset bases, asset categories running up to 25 years, whereas the liabilities profile, maturity profile will run only up to maximum of 5 years, other than the shareholders funds, maximum of 5 years, and the majority of them are in a 1 year time bracket. So when we take an average tenor of the asset profile, it is going to be in the region of about 10 years, loans and advances and investments altogether. So we are talking of 1 year liabilities profile, tenor maturity profile, and about 10-year asset profile. So the financial institutions are playing a magician's role, where from the average tenor of 1 year liabilities being used to finance asset tenors, average asset tenors of 10 years. This is because the financial institutions are able to do this magician's roles because the compliance to the rules and regulations and the maintenance of reputation with all stakeholders by the employees of the financial institution. And as long as there is no hiccups in the reputation maintained by the institution, there are going to be new deposits also going to be added on. That is why the 1 year liabilities profile is able to finance average 10-year asset profile. So this is the greatest risk. The short-term liabilities are being used to finance long-term assets. So assets and liabilities are mismatched. So therefore, it is a gigantic task. And because of the past practices by the professionals in the financial service industry, and it has been accepted that the banks and finance companies are maintaining high reputation and high level of compliance to the rules and regulations. So therefore, in the general public, in the minds of the general public, when you talk of banks particularly, they accept as a trustworthy party, trustworthy, who will maintain all the commitments without fail. So therefore, these mismatches and this scenario itself, long-term assets in the interest rate curve, longer the tenor, higher the interest rate. And when it comes to the liabilities profile, short-term liabilities, short-term interest rate curve is naturally less interest expenses on the liabilities. So therefore it is always high yielding assets and then low interest expenses on the liabilities. So naturally there should be a profit. Provided the liquidity is maintained by the institution and the reputation is maintained by the institution. So therefore, the financial services business is one of the high profit oriented or high return business. When we really analyze the Sri Lankan perspective, the pricing of the assets and the pricing of the liabilities, the difference is very high. Intermediation cost is very high. And as a result, as we discussed in one of the previous PowerPoint presentations, banks and finance companies have been able to maintain high level of profitability when the other industries, other sections of the economy was struggling, especially during the COVID pandemic period since early to 2020. So as you all know, the recent budget presented by the finance minister to the parliament also imposed a 25% surcharge tax surcharge on all those entities, especially banks, who make profit before tax of in excess of 2 billion rupees, 2000 million rupees. And on top of that, the financial VAT was increased from 15% to 18% by 3%. By 3%. So all this is because the financial services industry, the banks and finance companies are maintaining high intermediation cost. The assets are priced way above comparative to the pricing of liabilities. So what is the cost? I think I've been right throughout describing this concept. When the banks and finance companies are supposed to help, assist, or distribute the deposits collected by them to the deficit units or the needy sections of entrepreneurs to produce some goods and services, they have been pricing it extremely high. And as a result, they have been maintaining tremendously high profit levels. If they only had a little bit of kind thoughts about the rest of the economy, especially entrepreneurs who produce goods and services and finance their businesses at a little concession rate, then not only the general public and general consumer will be able to buy the goods and services produced by them at a cheaper price, the rate of inflation will be lower. Rate of inflation will be lower because of the fact that the deposits are accrued, savings are accrued by the mobilized by the banks and finance companies, and they create a large pool of funds manageable under their purview, and a decent spread would be the ideal situation. But however, the spread they are maintaining is way too high. So basically, assets and liabilities mismatch. Yes, it creates a risk, but by the factors that the reputation maintain and the compliance maintain, that risk, mismatch risk, can be mitigated. Then accrual accounting does not capture all risks. Accounting concepts, those who have learned accounting as a subject, you will understand when you say accrual accounting. Accrual accounting does not capture all risks, especially these asset and liabilities being mismatched. That risk is not captured by the accrual accounting principles. Then future movements in interest rates and exchange rates affecting profits and margins without any traditional default. So future movements in the interest rates and exchange rates would impact the profits and margins without any traditional default. That is to say, usually these finance professionals, especially treasurers of banks and finance companies, would study the future movement of interest rates and exchange rates and adjust the maturities of assets and maturities of liabilities to suit the future movements of interest rates and exchange rates, and then make adjustments to the portfolios of assets and portfolios of liabilities so that the entity is able to make the maximum profits as possible. So exploit future opportunities is meaning, again, the opportunities created by the movement of interest rates and exchange rates in the future, expected movements. Those opportunities are exploited by the banks and finance company treasurers to bring in high return. Then better equipped to counter competition with superiorly managed mismatches. These banks and finance companies treasurers are better equipped to counter competition with the superiorly managed mismatches. Yes, the larger the funds, there should be large profits accrued to the entity. But you find in some cases, large funds, other medium or small fund base managed by other entities have a superior profit levels maintained, have superior profit level maintained. A good example is that when you look at the Bank of Ceylon and People's Bank, two largest banks, their pool of funds is in the region of 3 trillion each, whereas the commercial bank and HNB maintain about 1/3 of that, about 1 trillion each. But see the profitability. These institutions, the annual profit levels maintained is in the region of 20-25 billion in each case. Whereas commercial bank and HNB having 1 trillion deposit base and BOC and People's Bank having 3 trillion deposit base, ideally they should be maintaining a profit level of 3 times commercial bank and HNB. But because of the superiorly managed mismatches by the commercial bank and HNB, enable them also to come very close to the profit levels of BOC and People's Bank. Just an example. And another example, in March 2020, soon after the COVID pandemic broke in, central bank infused liquidity to the economy, and the excess liquidity with the financial institutions, especially banks, were invested in government securities, all their excess funds were invested in treasury bills and bonds. So around the same time, central bank was instrumental in reducing the interest rate levels from about 10% to about 5% in the market. Reduce the interest rates from 10% to 5% in the market. So you would know what happens to the price of the treasury bills and bonds when the interest rates reduce. When the interest rates are reduced, price of the treasury bill and treasury bond goes up. So these financial institutions, especially banks, made huge capital gains during the year 2000 and then early part of 2021. So these levels of making profit was created by the central bank for those who have made hefty investments in the treasury bills and treasury bonds. Asset and liability management, ALM. ALM is the process of strategic balance sheet management. What is in a balance sheet? Liabilities and assets. In other words, the list of assets acquired by the financial institution and how they are financing through the liabilities. Asset and liability management, involving all market risks, liquidity management as well, and trading of financial securities and capital planning. Capital planning. Capital planning we discuss a lot under Basel I, Basel II, and Basel III regulations. But at the same time, the finance professionals in the treasury and in the finance department, they look at capital planning all the time, because when there is more capital, these financial institutions are able to create more risky assets. Risk-weighted assets. Remember we discussed there should be a minimum of 10% in the world standard, and Sri Lankan standards 12%. There should be capital of 12% out of the risk equivalent to 12% of risk-weighted assets. The capital should be there. Formulation, execution of business strategies, measurement of risk-adjusted returns, allocation of capital, product development, pricing, and promotional strategies. All these are functions under asset and liability management. Formulation and execution of business strategies. When one institution identifies a profitable area, they would create new products and services to serve the general public in that area of activity. And those business strategies are preconceived by the strategic planning committee, board subcommittee of the financial institution, and that financial strategic planning subcommittee, board subcommittee, will pass on the targets and the goals to be achieved to the ALCO and treasury and other business units operating in that area of business activity. Maybe trade finance, maybe credit card business or debit card business or leasing activities. Then measurement of risk adjusted returns. Periodically, the returns generated out of such business activity is measured or estimated, or not really estimated, it is actually actuals are compared with a proper measurement criteria. Then allocation of capital, again, is another critical function under asset liability management. The capital allocation should be to the appropriate profitable profit areas. The business activities need capital. So higher return business activities are naturally would be financed or allocated more capital. Then product development, pricing and promotional strategies are also directed to serve the business strategic objectives. On balance sheet business transactions, example, revision of interest rates and product development. We did discuss the on balance sheet and off balance sheet. What's the difference? On balance sheet is when transactions involved are settled in cash or in bank balances, transfer of money, actual transfer of money on balance sheet. Off balance sheet, there is no actual transfer of money right now, but the actual transfer of money may arise at a later date. Example, derivatives. To buy or sell a derivative, you might need a small fraction of the value of the transaction as margin deposits sometimes. And there are some derivatives which do not require margins at all. So there is no commitment of cash in the case of off-balance sheet transactions. So on-balance sheet business transactions, example, revision of interest rates and product development. Then on-balance sheet investment activities, example, acquisition of assets, equity investments, fixed income investments. Fixed income investments like buying treasury bills and bonds. Then off-balance sheet hedging strategies through derivative products. We discuss the interest rate swaps, futures contracts, and option contracts. And most widely practiced derivative in Sri Lanka is the forward foreign exchange contract. Forward foreign exchange contract is the derivative of the spot foreign exchange transactions. Objectives of asset liability management. Exposure risk by choice, not by chance. Asset liability management, one of the objectives is that your institution would be exposed to the risk by a selection criteria, not by choice, not by chance. The exposures are acquired by choice, by a selection process. It is not ordinarily created as such. So that is one of the objectives. Then risk management is another objective of ALM. Risk management, risk identification, risk measurement, and risk management. Management means diversification of risk as much as possible, and certain elements of risk which cannot be mitigated are usually managed through derivative products and other are sold. The risk amount is transferred to other entities which would buy such amount of risk for a fee. That is called derivatives. Then control volatility of interest rate, control volatility of net interest income, NII, is another objective of asset liability management. Net interest income, volatility is controlled or managed. Then control volatility of net portfolio value. The volatility of portfolio value is managed or controlled. So these are objectives of asset liability management. A drawing which depicts the risks managed by Treasury. Basically, market risk is at the center. Market risk is at the center. And liquidity risk, then foreign exchange risk, then interest rate risk, commodity risk, and equity risk all have an element of market risk. Then the credit risk and operation risk sits just beneath all these risks. Credit risk, the counterparty risk, and the operational risk in delivering the products and services. There will be operation risk in all of these products, attached to all of these risks. So this is a good overall look at of the asset liability management and the risk managed by a treasury. Best practices in risk management. Strategic direction. There should be a strategic direction always coming out of the board of directors, who are the representatives for the shareholders of a financial institution. Then integration, integrated risk management. All those risks, all these risks measured and managed in an integrated form is the requirement in financial services organizations to manage integrated risk management. And the Central Bank of Sri Lanka has a special direction requesting all the financial institutions to implement integrated risk management mechanisms. Then measurement system, the risk measurement system, measuring of all these risks. There should be a system to measure the risk. Then monitoring the variance of the measured risk in each of these component has to be monitored, and then should not be allowed to go out of control. Then balance sheet evaluation, contingency liquidity plan. I think we spoke a great deal of this contingency liquidity planning in one of the previous sessions. Off balance sheet management, contingency assets and contingency liabilities, maybe through derivative products. Then the fund management through nostro accounts and then other cash balances, etc., etc. Liquidity management techniques, funding diversification, funding gap assessment. We learned all these things. I'm just reminding them now because we discuss especially funding gap maturity buckets basis in detail. Composition of the off-balance sheet portfolio, funding strategy, and the credit rating. Finally, the external view of all these would reflect in the credit rating of a financial institution. Credit rating of financial institution. Funding strategy, especially when there is a parent company who could infuse more and more capital to the business, then that's a huge plus point to the credit rating of the institution. The support of most assets are illiquid and long-term. Liabilities are liquid and short-term. This is what we discussed just a while ago. The liabilities have an average tenor of 1 year, whereas assets long-term has average tenor of 10 years. And these assets are mostly illiquid. They cannot be, the loans granted cannot be recalled at short notice. But the liabilities, the savings and current account deposits are technically on demand, could be withdrawn at any moment by the depositor. Even the case of fixed deposits, 1 year, 2 year, 5 year fixed deposits, depositors have the right to come and ask for premature withdrawals. Although the contractual obligation is to keep the deposit until the maturity, however, the customer could appear in front of the counter and then cite various reasons and then asks for his money back prematurely. The pricing strategies remain when it is premature withdrawal. That's a different question. But however, the short-term liabilities are liquid and the long-term assets are illiquid. It is interesting here to notice that whenever loans are granted by the banks and finance companies, and if the borrower wishes to pay off the loan borrowed prematurely, some institutions, some banks would want to charge them for settling the loan in advance prematurely. Very ironical situation which cannot be understood or described logically, because whatever the loans granted, the depositors' money granted as a loan to customers, borrowers, when they come forward to pay off the loan in a period, in a premature period than the contracted period, the banking institution would want to charge a penalty. It's a laughable logic anyway, but the logic put forward is that the contracted loan period is reflected in the interest rate charge, in the interest to be paid, and the funds committed to that period, when it is repaid prematurely, the bank loses its revenue. This is the logic or argument put forward. But sensible actions, thinking would sometimes vary, because if the loan granted goes into default, then it is past due loans, non-performing loans. But when the customers wants to come and repay the loans borrowed prematurely, they want to charge. So it is sometimes they are not in consistent logic. The logic behind that thinking is not very consistent. Short-term liabilities, conceptually a means of disciplining financial institutions where threat of runs which may turn out to be real. Short-term liabilities, the thinking behind this point is that when liabilities are on the short term, and with each maturity in the short term, the liabilities could be taken away, the deposit could be withdrawn. So therefore, the liabilities are in the short-term nature to discipline the financial institution in their management of finance. Because if in the short term, if the liabilities are withdrawn, there could be run on the bank. There is always a threat of runs, which may turn out to be real. Possibility for runs to affect other financial institutions, contagion effect. When one financial institution goes down, the other similar, other peer institutions can also be affected because the balance sheet, because of balance sheet similarities and the uncertainty or counterparty exposure. So this is called contagion effect. Contagion effect. Prudent liquidity management. Holding liquid assets is a net defensive position, cost in terms of lower profitability. Holding liquid assets, holding more and more liquid assets is a defensive asset and liability management strategy. And there's a cost in terms of lower profitability. Dissipating withdrawal risk by diversifying funding sources, liability management. On the management of the depositors or the liabilities, the withdrawal risk can be mitigated by diversifying funding sources, by diversifying the liabilities base from, say, from the children's savings accounts to young adults savings accounts to savings accounts to elders savings accounts, senior citizens savings accounts. So likewise, diversifying the funding sources will enable to dissipate or mitigate withdrawal risk. In the liquidity management, one could say the financial institutions seek low volatility ratio. This is measured by or expressed by volatile liabilities minus liquid assets. Volatile liabilities minus liquid assets divided by total assets minus liquid assets. And the answer should be less than 0. Answer should be less than 0. So formula again, volatile liabilities minus liquid assets, total assets minus liquid assets. So the volatile liabilities minus liquid assets, that component when divided by total assets minus liquid assets, and the answer should be less than 0. So that is a low volatility ratio. Then the backup, capital adequacy to ensure creditworthiness maintained to face shocks. Capital adequacy norms expressed or directed or regulated under the regulations by the central bank. Capital adequacy to ensure creditworthiness maintained to face shocks. Important role of supervision, reserve management, and money market infrastructure ensuring liquidity maintained. These are the safeguards in prudent liquidity management. Important role of supervision. Supervision by the internal internal setups or internal or departments of the organization, namely the risk management unit, the internal auditors, the back office, and then compliance department. Important role of supervision. Finally, the external auditors and the central bank supervision. So all in all, important role of supervision and the reserve management. Reserves maintain reserve requirements to be maintained, and money market infrastructure, money market operational aspects, ensuring liquidity maintained. So the money market operations will enable the financial institution to borrow or raise liquidity in prudent liquidity management events. Liability management, ensuring maintenance of continuity and cost effectiveness of funding assets. Now, when you say ensuring maintenance of continuity, I was speaking of maintaining the reputation and maintaining the compliance culture that will enable the liabilities being existing liabilities, the existing deposits being renewed all the time, existing deposits and those liabilities not being withdrawn from the organization. And when the reputation of the institution is high, naturally there will be new deposits coming to the institution on a day by day. So ensuring maintenance of continuity in the liability base has to be of paramount importance, and cost effectiveness of funding assets. The asset base is always funded by the liabilities, and the cost effectiveness of the liabilities will enable the financial institution to maintain the profitability. The low-cost funds, savings accounts, savings balances, and current account balances are, in short form, we call CASA. CASA balances are very important for the high profitability of financial services organizations. Diversification to reduce liquidity risks. Certificate of deposits, securitization, subordinated debt, interbank borrowing, time and demand deposits. Diversification to reduce liquidity risk. When you diversify your liabilities in all these angles, certificate deposits, securitization, subordinated debt, interbank borrowing, time and demand deposits, etc., 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 will reduce liquidity risk. And liability mix, choice of stable collection of retail deposits, choice of stable collection of retail deposits, as opposed to more price sensitive, volatile wholesale deposits. So when there's a choice of more stable collection of retail deposits as against more price sensitive volatile wholesale deposits, there is going to be the liquidity risk is going to be so much less. So the liability mix has to be analyzed and then managed very well. Maturity structure, maintain mismatches at tolerable levels using duration without reducing flexibility. Maturity structure, maintain mismatches at tolerable levels using duration without reducing flexibility. Interest rate risk. Risk of adverse movements of interest rates on net interest income and market value. Risk of adverse movements of interest rates on net interest income and market value. Here, I think we discussed some time back that when the interest rates, we take practical example, from the beginning of 2020, when the interest rates reduced from about 10 to 11% to about 5%. The bankers and the finance companies rushed to reduce the price interest rate paid on liabilities, but they were reluctant to reduce the interest rates charged on the assets or loans. So at the same time, when the interest rates are rising, the bankers and finance companies will be rushing to adjust the interest rates on loans and advances, but they would be very reluctant to raise the interest rates on deposits and the liabilities. So that is the normal or usual banking practice adopted by the financial industry, thereby, at least for the few months interim period, their net interest income is increased to about 2-3 times as than normal times. Net interest income, as you know, is the difference between the interest charged on the loans and advances minus the interest paid on the deposit liabilities, net interest income. So higher the net interest income, higher the profitability, but you run the risk of losing customers on either side when you do not maintain NII of par level to the market rates. Economic value of portfolio equity. The portfolios must be maintained with sound economic value of portfolio equity. measuring interest rate sensitivity. These are the normal criteria to measure the interest rate sensitivity. Net interest income sensitivity is equal to change in net interest income for 1% adverse change in interest rates divided by the base case net interest income. The other method is that net interest income sensitivity is equal to change in net interest income for 1% adverse change in interest rates divided by total assets. Net interest income sensitivity to 1% change in the interest rates. That is the sensitivity measured here. Economic value of portfolio equity, again measuring interest rate sensitivity. Economic value portfolio equity sensitivity, change in economic value portfolio equity for 1% adverse change in interest rates divided by base case economic value of portfolio equity. Next method, economic value of portfolio equity sensitivity is equal to change in economic value of portfolio equity for 1% adverse change in interest rates divided by total assets. You can see these measurements in the final accounts of the banks or finance companies if you have the time to go through them. Then analytical tools. Short-term accounting basis and long-term economic basis. Gap analysis. There's a long-term duration analysis. Then short-term simulation of net interest income. Long-term the simulation of economic value of portfolio equity. The short-term economic value at risk, EAR, economic value at risk, and the long-term value at risk, the component of risk in any portfolio. All right. That set of slides are over. We have to be looking at a different set of slides now. Profitability of banks and financial institutions. I know these concepts are a little depth, but however, you should be going through these things. At least you must say that, okay, I have listened to this. I know I will go through this when it comes to a real application of the concepts to your organization. So what is profitability? The capacity of an organization to make profits. The profitability measured and compared in terms of return on equity and return on assets. Equity is the shareholders' funds. Assets are the portfolio assets in an organization. The return of equity and return on equity and return on assets. Return on equity, net income divided by average total equity. Net income divided by average total equity. Then you get return on equity. Return on assets, net income divided by average total assets is return on assets. Average total assets equals total assets at the end of year plus total assets at the start of the year divided by 2. This is the average total assets. Total assets at the beginning of the year and the total assets at the end of the year divided by 2 is the average total assets. So the return on assets is computed like that. Profitability is the most important factor for shareholders. The people who are invested in the business, the shareholders, for them, the profitability is the most important factor. Dividends payment depend on profitability. Dividends payment depend on profitability. Share value depends on profitability. As you all know, the shareholders receive dividends for their shares investment, and higher the profitability, the shareholders get a higher share of dividend payments. Other than the profit that are going to be retained in the business for continuity of business activities, when there is a high level of profitability, the dividend payments to the shareholders is also going to be high. And that is also going to contribute to the share value depends on profitability, because the return expected by the shareholders, when there is high return, the existing shareholders will not think of exiting from the investment, or they will hold on to the share ownership. But the moment the profitability is going to decline, reduce profitability, meaning the existing shareholders too will think of selling the shares that they own. At the same time, when there is high profitability, there will always be new shareholders seeking to buy the shares. And when the profitability is reduced, the demand from the new shareholders for the share will reduce. So the price of the share or share value will depend on the profitability. Return on equity measures the percentage return on each rupee of stockholders' equity. It is the aggregate return to stockholders before dividends. It is the aggregate return to stockholders before dividends. Return on assets measures net income per rupee of average assets owned during the period. return on assets is the net income per rupee of average assets owned during the period. Depending on the performance of the company, return on assets will vary. Banks and finance companies' profits will banks and finance companies' profits or the income, major portion of profits derived from charges and commissions from services and interest from assets. So assets are equal to liabilities plus the bank's capital or equity. Assets equal liabilities plus the bank's equity capital. All assets cannot be used to earn income. Out of total assets, some portion must be in cash, vault cash, ATM cash, etc., with no return but added costs. Vault cash and ATM cash, as we discussed before, has to be insured, has to be safeguarded with security, and on top of that, up to the value of the cash held, there won't be an interest income. The income is lost as long as they are held in vault cash and ATM cash. And statutory reserve requirement, no interest income. Could banks increase assets? Yes, it could. There need to be more deposits. They need more deposits. To increase assets, there should be a way to finance the increased asset. They need more deposits, or else they need more capital. They need more capital. Now, the capital, regulatory capital is, for banks, is about 10 billion. For finance companies, I guess it is about 2.5 billion at the moment, and they are going to increase it up to 5 billion, I think. Then on top of that, risk capital as well. So as long as there is a source of fund through deposits or capital, then the assets could be increased. Without a funding source, no asset can be increased. Capital divided by capital weight on credit risk plus market risk and plus operation risk equals 10%. What do you recollect with this capital divided by capital weight on credit risk and market risk and operation risk? It is the Basel II regulation, isn't it? 10% of capital, then increases assets without increase of capital lead to high risk leverage scenario. Increases in increases in assets without increase in capital lead to high risk. You are only increasing the leverage. Why high leverage is risk? Example, Lehman Brothers leverage ratio was more than 30 to 3 times before financial crisis. The subprime mortgage crisis in 2007-8, Lehman Brothers, a bank which existed for more than 160 years, has to be declared bankrupt because it leverage maintained was 30 times into 3 during the time of financial crisis. 3% decline of value of its assets wiped out its capital entirely. Lehman Brothers maintained this high leverage for high profits, but it forced the Lehman Brothers to declare bankruptcy in September 2008 after 160 years in the financial services business. You remember during the subprime mortgage issues, the subprime mortgage bonds were bundled into and then sold to generate more funds and then reinvested in the subprime mortgages bonds and then again bundled, and so thereby creating more and more assets without a proper funding source. Net income. Net income equals commissions plus charges plus net interest income on assets minus interest paid on liabilities. Net interest income partly depends on the interest spread. Interest spread is equal to average interest rate earned on assets minus average interest paid on liabilities. Interest paid on liabilities, basically net interest income. Cost of funds. Monitor cost of their funding sources. Monitor cost of their funding sources. Alter financing cost, changes in interest rates, composition of liabilities and equity. Do corresponding changes in assets yield to maintain profit margins. So cost of funds for any organization is going to be a materially important concept. So any organization should monitor cost of their funding sources. They could alter financing cost through changes in interest rates and composition of liabilities and equity. Now there's an argument between the equity and the debt. When debt is raised, there is a market interest rate that you have to pay. And there's a definite maturity date for any type of debt. On the maturity date, the borrowed money on the debt has to be paid. Example, treasury bills and bonds or debentures raised by various banks. So on the maturity date, the funds borrowed should be paid with the capital plus interest. But when it comes to equity, shareholders' funds, those who buy shares in a financial services organization, is there a maturity date? No, there is no maturity date, because the financial services organization, the company must survive until infinite time. But how do the shareholders exit? The shareholding can be sold in the secondary market through the stock exchange or any other way arranged, the secondary market. And what is the cost of funds? In the case of debt, there is a market rate of debt fixed for the debt along with the maturity. But on the equity, there is no maturity date. At the same time, dividends can be paid only depending on the performance of the company. If there's high profitability, yes, high dividends can be paid. So therefore, to retain the equity, companies usually try to pay higher dividend. So there is an accepted norm in the accountancy field, accountancy area, where the equity, cost of equity is very much higher than the cost of debt. If we can put a numerical value for the cost of equity, it could be in the region of 18%, 20%, 25%, or 30%. Whereas debt, debentures, and other debt instruments would attract only about, in the case of treasury bills and bonds, it will be about 7-8% currently. But the debentures and other debt instruments might attract a maximum of 10% or 11% or 12%. Whereas equity capital cost is in far excess of that. But at the same time, equity shareholders also run the risk of dividends being paid at lower rates, or some years no dividends being paid at all. So that's the risk that they undertake when they invest in equity share capital. Net interest margin. High net interest margin indicates a well-arranged bank and future profitability. Well-arranged bank, financial institution, and future profitability. Net interest margin divided by average total assets equals net interest income on average assets. Net interest income on average assets. Profitable clientele for sustainable profitability. Profitable clientele for sustainable profitability. Make unprofitable client base to profitable. Example, impose very low fees for regular transactions. Example of 5 rupees for each ATM transaction. Consolidate services into one package. Effective cross-selling culture. Increase customer switching costs. Basically, making the profitable clientele for sustainable profitability. On and off, as we discussed before, there have been incompatible fees and levies charged by the banks particularly. Now, when customers walk into the counters and demand the services through a cashier or teller, the banks have to incur the overhead costs of maintaining the counter, security, and the salaries and overheads and the overtime payments of the cashiers and tellers and back office staff. And increasingly, banks have been trying to push the customers walking into the counter to the ATM machines to withdraw their money. And each time when they withdraw, there's a 5 rupee charge. A logical question here, why cannot the banks allow the ATM withdrawals free of charge, as we saw a few years before, so that increasingly people will go to the ATMs than walking up to the counter, which is a high cost to the banking institution. But however, to collect revenue, they have come out with a smart idea, within inverted commas, smart idea of charging 5 rupees for each ATM transaction. So in other words, discouraging the use of ATMs. So actually speaking, the ATM transaction, ATM withdrawal should be free of charge. So consolidating services into one package is also going to help make the customer profitable to the bank or finance company. An effective cross-selling culture is also going to be helpful to the profitability of the bank and the finance company. And when you increase the customer switching cost, customers going and seeking the services from other competing organizations, switching cost. When you increase that, the customers will be compelled to obtain the services from this organization because of the increased switching cost. Liquidity management of banks. Liquidity management reduces the profitability of an adverse situation development. As we were discussing right throughout, maintaining liquidity and maintaining profitability is something like opposing forces. If you keep liquid funds, there's lower profitability. If you maintain the barest minimum liquid funds, and then there's a possibility of higher profitability. So liquidity management reduces the profitability of an adverse situation development. Higher the maturity of asset, higher the return. Higher the maturity, the longer the maturity of asset, then there is high return for the organization. Sustainability requires short-term liquidity matching. To sustain the organization and going through all the liquidity crisis require short-term liquidity matching. Prior to 1930s, banks were encouraged to make only short-term liquidating loans. Short-term liquidity loans were only granted by the banks prior to 1930s. Reason such loans easily matched the maturity of bank deposits and enable banks to meet deposit withdrawals with funds from maturing loans and assets. Liquidity management of banks. Liquidity management is a day-to-day responsibility. Well-managed banks monitor its cash position carefully and maintains low liquidity levels within regulations. Highest yield are the least liquid. Least liquid assets are going to bring the highest yield. More recently, banks have focused on liability management. According to the liability management theory, banks can satisfy liquidity needs by borrowing in the money and capital markets. According to the liability management theory, banks can satisfy liquidity needs by borrowing in money and capital markets. Today, banks use both assets and liabilities to meet liquidity needs. Available liquidity sources are identified and compared to expected needs of the ALCO. Available liquidity sources are identified and compared to expected needs of the ALCO. Now, expected needs of the ALCO depends on the expectations of the board of directors. Board of directors are the representative of the shareholders seeking profitability, and the board of directors will have their expectations or the goals or targets set for business, and those goals and targets and expectations are at operational level decided and rolled out by ALCO. So at treasury front office level should be activating those targets and then expectations with practical strategies carried out by them. So as we discussed before, the risk management unit and the compliance unit are responsible to see whether these targets and expectations are being actually operationally activated by the treasury front office as declared by the ALCO. Key considerations includes maintaining high asset quality and a strong capital base that both reduces liquidity needs and improves a bank's access to fund at low cost. When banks and finance companies maintain high asset quality and a strong capital base, naturally their credit rating will be higher and will reduce the liquidity needs and improve the bank's access to fund at low cost. Successful management of long-term earnings will exceed peer banks' earnings. successful management of long-term earnings will exceed peer banks' earning. So in the competition, they'll be way ahead of the peer banks. Increase capital and overall liquidity. Increase capital and overall liquidity. Liquidity requirements of banks to efficiently meet obligations to fund loans, increase assets, meet off-balance sheet claims, improve on sustainability. Improve on sustainability. Liquidity planning, short-term planning similar to tax planning. Example, stability requirement, investment in government securities. Liquidity planning has to happen well in advance. So similarly, similar to planning of taxes to be paid, also decided well in advance, the strategical objectives. So likewise, liquidity planning also has to be planned well in advance. Medium-term and long-term planning. Forecast net fund requirement, gap analysis on liquidity requirements for overall bank growth. So when you really have your documentation plan for this forecasting of net fund requirement, gap analysis on liquidity requirements for overall bank growth, then you can plan your medium to long term liquidity needs. Liquidity planning focuses on guaranteeing immediately available funds at low cost. Liquidity planning focuses on guaranteeing immediately available funds at low cost. Comfort letters, guarantees from central bank, Ministry of Finance and leading banks will strengthen the liquidity planning. Liquidity risk basically rise due to funding long-term assets with short-term liabilities, being unable to honor maturing liabilities. Toward liquidity management, there should be liquidity management policy. This should spell out, the liquidity management policy should read funding strategies, liquidity planning under alternative scenarios, prudential limits, liquidity reporting and reviewing structure, auditing guidelines, contingency plan. ALCO should execute board-approved limit. ALCO should execute board-approved liquidity management policies, procedures, and practices. Board should periodically monitor the liquidity profile of the institution. Liquidity measuring, net loans, these are a few concepts to measure the liquidity. Net loans to total assets, loans to customer deposits, liquid assets to short-term liabilities. Liquidity equals large liabilities minus temporary investments divided by earning assets. Large liabilities equals market sensitive wholesale deposits. Temporary investments equals those maturing within 1 year short term. Purchase funds to total assets. Purchase funds to total assets. Then purchase funds includes interbank borrowings, other money market borrowings as well, purchase funds. Then commitments to total loans. Commitment meaning letters of credits, guarantees, and acceptance. Analysis of liquidity. Track cash flow mismatches, profitability of those cash flows in different time bands. Measuring and managing net funding requirement. Use maturity analysis to measure and manage net funding requirement. Use maturity analysis. Then calculate surplus or deficit. Cash flow analysis. Identify seasonal patterns. Measure potential deposit reductions. Demands for loan. Investment strategies. And statutory obligations. Measure future behavior of on-off balance sheet positions. Example, repayment of loans, premature closure of deposits, contingent liabilities, early settlement of loans, projection of cash flows concentrating long-term and day-to-day basis. Evaluation of liquidity. Liquidity position under different stress situations. Liquidity positions under different stress situations. Scenarios, stress scenarios can be built on most probable practical outcomes, and liquidity positions under different stress scenarios will give a good evaluation of the liquidity. Consider positive or negative scenarios in the market. Internal factors. Estimate liquidity under bank specific crisis scenarios. Estimates worst case benchmarks. Prematurely close of core deposits, substantial share of assets turn into non-performing, etc., etc. What is the impact at worst case scenarios? Development in the non-performing advances creates illiquid assets. Development of non-performing advances creates illiquid assets. Downgrade rating. High cost liquidity. Borrowing from money markets. High leverage. Loss of capacity to restructure positions. Attract long-term funds through debenture issue. Liquidity versus profitability. If banks are more comfortable with liquidity, then lower return on equity and assets. When the banks and finance companies are comfortable with liquidity, then lower return on equity and assets is possible. As we discussed before, the liquidity and profitability are opposing forces. So the treasury experts has to strike a balance and whilst ensuring sustainability of the organization through liquidity, adequate liquidity, profitability must be created. Large holding of cash assets clearly increases the liquidity and decreases profits, and opportunity loss of interest income, yield on assets. Bankers practice prudent liquidity policies with focus on profitability. So bankers usually do their prudent practices and follow practical guidelines to achieve prudent liquidity policy with focus on profitability. So we were able to complete the slide presentation right on time. All right. I notice most of the participants have left. Only 3 are remaining. Anyway, this brings us to about virtually to the end of semester 3 as well. And next week, Tuesday and Wednesday, we'll discuss some topics pertaining to semester 4. And as agreed, on Thursday, 25th, we will listen to your presentations. All right.